Hey everyone, welcome back to Corporate Decoder, the place where we uncover the hidden stories behind the numbers, and tonight we are diving deep into Harding Loevner Funds Inc.'s latest annual shareholder report. And let me tell you, there are some major players and some interesting moves happening in the world of global investments. Before we start, if you appreciate getting straight insights from Corpo, rate documents, make sure you're subscribed. We also have a Discord community linked in the description below where we break down these filings and more. This is essentially a deep dive into how several of Harding Loevner's funds performed over the past year, with a focus on the period ending the 31st of October 2025. We are going to look at their performance, their top holdings, and what management has to say about the ups and downs of the market. Let's start with the Global Equity Advisor Class Fund HLMGX. According to the report, this fund saw an increase of over 13% after fees and expenses. Now that sounds pretty good, but its benchmark, the MSCI All Country World Index, actually jumped over 22%. So while it made money, it lagged behind the overall market. Looking at the cost for a hypothetical $10,000 investment, the Global Equity Advisor Class Fund cost investors about $115, which is around 108% of that investment. These costs are pretty standard for actively managed funds, but it is always good to see how much is going towards management versus actual investment growth. Management chalks up the underperformance to some weak stocks in the information technology and financial sectors. Specifically, they mentioned Globant and Accenture facing concerns over weak demand and fears that artificial intelligence tools might reduce the need for consultants in financials. TradeWeb fell on worries about rising competition. These are big companies and their struggles definitely impacted the fund's overall return. On the flip side, streaming entertainment company Netflix enjoyed strong growth from its new ad-supported subscription plan, which helped. One of the fund's top performers was Alphabet Inc. Their holdings like Microsoft, Amazon, Tencent, and Schneider Electric Safe represent huge chunks of the portfolio, showing a clear focus on the biggest tech companies. And established global players, this concentration can be both a strength and a weakness, depending on how these giants perform. Now let's shift to the International Equity Institutional Class Fund HLMX. This one returned nearly 20%, which sounds great. But again, it lagged behind its benchmark, the MSCI All Country World ex-US Index, which grew over 24% management points again to the impact of high-quality companies underperforming, which the fund emphasizes, and this is a key challenge for them. When we look at the top holdings for this fund, we see names you'd expect like Taiwan Semiconductor Manufacturing, Samsung Electronics, SML Holding, and HDFC Bank. It shows a global outlook, but also a heavy reliance on big tech and financial services from various regions. Moving to the Institutional Emerging Markets Fund, HLM's, this fund rose over 22%, but also underperformed its benchmark by a significant margin. Management attributes this to weak returns in information technology and financials despite good performance in real estate. And energy, this is a recurring theme. The fund is holding companies that are struggling in key growth sectors, which is eating into its overall performance. For the Institutional Emerging Markets portfolio, the top holdings are heavily weighted towards Taiwan Semiconductor Manufacturing and Tencent Holdings. LTD, this heavy concentration in a few markets and companies, is a big part of the story here. The Emerging Markets ex-China Fund HLXCX is interesting because it actually liquidated on the 19th of November 2025. This means it is no longer an active investment vehicle for new money, and its performance data up to October only reflects its wind down period. Management notes that as of the 31st of October 2025, the fund consisted entirely of cash preparing for this liquidation. The portfolio of investments for this fund shows 942% in short-term investments, primarily the Northern Institutional Fund's Treasury Portfolio Premier shares. This is expected given the liquidation and signals that it was essentially holding cash and liquidating its other assets. The Chinese equity fund HLMCX performed well with a return of over 26%, but it still lagged its benchmark, the MSCI China All Shares Index, which jumped nearly 30%. Management again cites poor stock selection across most sectors, despite good performance in information technology. The fund is holding on to a single position, which is unusual and likely due to its liquidation. The top holding for the Chinese equity portfolio is a staggering 10.07% in the Northern Institutional Funds Treasury Portfolio Premier shares. This again strongly suggests a fund that is either liquidating or has shifted entirely to cash and is awaiting its final wind-up. Now for the Frontier Emerging Markets Fund HLFMX, this fund rose over 12%, but again significantly underperformed its benchmark, which saw gains of over 30%. Their management points to weak relative returns in information technology, consumer staples, financials and consumer discretionary areas. Vietnam, a key market for this fund, surged. but it seems the fund missed out on much of that upside. Looking at the top holdings for frontier emerging markets, we see a more diversified list, including Society D Exploitation, Desports, Credicorp Ltd, and International Container Terminal Services. These are companies from various regions and industries, indicating a broader strategy compared to some of the more concentrated funds. For the Frontier Emerging Markets Investor Class Fund, HLMOX, the performance numbers are quite similar to the institutional class with a 12.74% return, but still lagging the benchmark. The story is the same weak relative returns in key sectors and missing out on some major market gains. This suggests a consistent strategy across share classes, but one that struggled to keep pace with the broader market over this specific period. A notable administrative change is the dismissal of KPMG LLP as the independent registered public accounting firm and the appointment of PricewaterhouseCoopers LLP as the new auditor. This is a common occurrence in the industry and usually signifies a rotation or a desire for a fresh perspective from auditors. This part of the filing is really interesting. It's the board's justification for continuing their contract with Harding Loevner LP. They go through detailed reviews of performance costs and the quality of services provided. It mentions that during the 1-year period ending March 2025, each portfolio underperformed its benchmark, except for one, which is a key takeaway. They chalk up some of this underperformance to the market favoring growth stocks and the rise of passive investing, which are tough headwinds for active managers. Management defends their strategy, emphasizing a bottom-up approach focused on quality growing businesses. They acknowledge periods of underperformance, but highlight historical outperformance over longer terms and their commitment to risk management and incorporating environmental, social, and governance factors. This is their way of saying trust the process even when the short term looks rocky. Looking at the financial highlights, the net assets for the global equity institutional class are listed at over $350 million, which is a significant chunk of money, but down from over $497 million. The previous year, this shows a decline in assets under management, likely due to a combination of underperformance and share redemptions. The expense ratios are a critical part of understanding fund performance for the global equity institutional class. It is 0.85%, which is competitive, but remember that 13.33% return we talked about. This means over 1% of that return was eaten up by fees before it even got to the investor. And finally, checking out the actual portfolio investments for the global equity fund, we see massive holdings in the US accounting for over 57% of the portfolio companies like Alphabet, Microsoft, Amazon, Meta, and Nvidia are their top 10 holdings. This confirms their strategy of betting on the biggest names in the tech world with a significant global overlay. So what is my take on Harding Loevner Funds Inc. based on this filing? Well, their active management approach clearly struggled to keep up with the benchmark in many of their funds over the past year. This is a real risk for investors who are paying higher fees expecting outperformance, and when that doesn't happen, it erodes returns, particularly after those fees are accounted for the concentration in information technology and a few key global giants is also a double-edged sword. These companies can drive massive gains when they are winning, but they also pose a significant risk if they face headwinds. The fact that some funds are liquidating or have very unusual cash-heavy portfolios implies potential strategic shifts, or perhaps a winding down of certain strategies, or funds. As always, do your own research and understand these risks. This is not financial advice, just a breakdown of what is in these filings. What stands out to you from this report? Let me know in the comments below. If you found this deep dive helpful, give this video a thumbs up and subscribe for more unbiased analysis of the financial world. Hit that notification bell so you don't miss out. On our next video, we also have a fantastic community on Discord, so come join the conversation. There, the link is in the description below. Thanks so much for watching, and we'll see you on the next episode of Corporate Decoder.